Welcome to Multifamily Insights. I'm your host, John Kasman, and I want to thank you for joining us for another great episode. Now, if you're enjoying the show, do me a favor, leave us that rating and review. I want to hear what you love about the show, but also if there's something we can do to make it work harder for you, let us know. And if this is your first time listening or you just haven't done it yet, be sure to hit that subscribe button so you don't miss an episode. Now, today we're going to be talking to Tom Dunkel. Tom Dunkel has a background in corporate finance and 25 years of real estate investing experience. Now he brings his extensive experience to Belrose Asset Management. Now he takes the company from the startup stage all the way now to specializing in discounted asset opportunities nationwide since 2006. Let's welcome to the show, Tom Dunkel.
Hey, John, thank you so much for having me. Pleasure to be here.
Absolutely. Absolutely. Hey, Tom, thank you for coming on the show. I went over your bio at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Sure. Yeah. So I'm a corporate refugee. I was in corporate America for about 12 years or so after finishing up business school. I did some really cool stuff. I did mergers and acquisitions and corporate finance work in aerospace. I actually worked with some astronauts and some fighter pilots and some really accomplished people, Marines, Gold Glove boxer at the Naval Academy. So I had some great people that I learned from early on in my career, but I had always wanted to do something on my own. And sometimes it's tough to make that shift, John, from corporate cushy life to going out on your own. So mine happened actually quite abruptly. 2006, I was fired from my corporate finance job at a publicly traded company. And I was like, okay, I guess this is the sign that I needed to actually go out on my own. So of course, 2006 was probably maybe the worst time in history to get into real estate, but that's what I did. And so definitely learned some hard lessons over those first few years. Got my butt kicked pretty good, lost a lot of money, and but learned some lessons, and just wouldn't really change it for the world because I think it really set me up for future success. That level of adversity.
Hey, thank you for sharing that. And I think it's helpful to understand, you were there, you were in corporate finance, you had a chance to work with a lot of successful and very interesting industries as well. But also in 2006, that all changed. We got let go from that role and then dove straight into real estate. You talk about that being a hard time to get into real estate. Talk to us about some of those challenges, particularly when the economy changed.
Sure. Well, again, having had a great education and a great training in corporate life, I figured, hey, this is going to be easy, right? Going out on my own, no problem. But when you're, all of a sudden in charge of, hiring a team and, finding office space and, setting up the office and, getting the right support staff in there. And I started out doing residential wholesaling and fix and flip stuff like a lot of people start out. And, so I was spending a lot of money in advertising. So there's a lot of money going out the door. And, of course, the market was moving away from us that entire time. So I just kept having to chase deals. And, so I definitely learned during that time, John, that it's actually pretty easy to buy real estate. If you pay cash and close tomorrow, you can buy as much real estate as you want. Where real estate gets challenging is the execution of the strategy. So if you don't have the right team and you don't have the right, contractor, if you're doing fix and flips, or you don't have the right operations team like we do at Belrose Storage Group, we have a phenomenal operating team, and that's why we've been able to be successful. Because we can buy the real estate, but unless you have the team there that can execute that plan and get you in a position where you have optionality at the time of exit. In other words, you can either hold it if maybe the market is not in a great spot right then, you can still hold it and still generate your cash flow. Or if the market is strong, then you can sell and move on to the next deal. So to me, it's easy to buy. It's much tougher to operate.
Yeah, and that's something we're seeing right now with the market shifting as well, right? Is making sure that you can absolutely operate and implement the business plan that you have for whatever that property is. You
Correct.
talked about making that transition for yourself, coming from corporate America, being kind of a high income earner. And there's certainly pitfalls for those other high income or high net worth earners. What are some of those things that people need to be aware of?
Sure. Well, I know it's certainly daunting, John. Like, I remember back in my corporate life, I was wanting to do something different, but I wasn't really quite sure how to go about doing it. So, as I mentioned earlier, I had to kind of learn quick. But I think for a lot of high income earners, it's tough to figure out how to get that right, due diligence framework in place, for example. So, we have a resource at our website, Belrose Storage Group. We call it the Safe Investing Method, and it's specifically for high net worth earners who might need that due diligence framework because maybe they're a doctor or a lawyer or other successful sales guy or engineer, what have you. That's their world. That's what they know. They don't really know alternative investing other than to know that, hey, it's real estate based, and in the case of self storage or multifamily. But that's great. But how do I look at this deal and make sense of it? So our ebook gives a framework for those folks to just walk through basically a series of due diligence questions. And I always encourage people too that if you're learning us, if you're reaching out to a sponsor like us, uh, and you're asking them questions, and maybe the answers aren't quite resonating with you, or something just sounds a little off, just stop and say, okay, thanks for your time. Move on to the next deal, because there are a lot of opportunities out there. Definitely need to know where to look for them. Your real estate investment groups, or of course these days, with social media, you can go on to LinkedIn or Facebook. They have all kinds of groups for real estate investors, for professionals. They're looking for sponsors. That's a good place to start. But you got to have those questions to ask, so you know who you're working with, you know what the asset is that you're investing in, the financial projections, are they making sense, and you understand your exit strategy. How is that exit going to come about? Has the sponsor done that before? Unfortunately, in real estate, it's not as easy as going to schwab.com, click, 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 and you get to sell your position and get your money. That's not how it works. So as an investor, you need to be comfortable with your money being tied up for a period of time and believe in that exit strategy. So I'd encourage folks to just pop over to our website, pick it up. It's free. You don't have to give your name or email or phone number or anything. So it's just our little value add back to the investing world.
No, that's a great tip there. If you want to check that out, it's at belrosestorategroup.com. That's that safe investment ebook that you have there available.
Mm-hmm.
You mentioned in what you were just saying that, making sure you're asking questions to the sponsor. And if you don't like the answer, or the answer just seems a little off, move on, find another group to work with, or just kind of continue to educate
Mm-hmm.
yourself and look for other opportunities. Give me an
Right.
example of that, right? Because I think that sometimes, when you get into the situation, it's a little harder to figure out like maybe what those red flags are. So is there a question or something that, someone who's looking to invest passively either should ask or they should look out for if they are having those conversations?
Sure. I think it really does hinge largely on the sponsor. As it should be, a big cap in our safe investing. It should be a big capital S, and then maybe the others letters smaller. But because we've over the years attracted some very, very high net worth investors, nine figure net worth types of guys, and they tell us, they're like, hey, now that we know you, that is such a huge hurdle for us to get over. Now it's not a matter of, do we trust the sponsor? It's more just looking at the deal. And so that was really encouraging. I think, John, and look, as an entrepreneur, where I had to kind of bootstrap things early on, sometimes you're not always set up the right way. So I do feel for those folks who maybe are just starting out as a sponsor and they're trying to get going. But as an investor, if and I am a passive investor in other people's deals, if I see like a deal that comes across my desk and it's so and so at gmail.com, I'm like, okay, so you don't really have a team behind, or you haven't even gone to the step of creating kind of a professional persona out there. And not that we want things to be fake or superficial or whatnot, but at least have at least have an email address that suggests that you've put some time into building up your business. And that would be the other thing too, is I think it's important to see that there's a team and some experience behind the investment. Because there's a lot of, flashy, salesy type guys out there, and you want to make sure that it's not just that guy, right? You want to make sure that, they have systems, they have process, they have a team, they have a strategy, they have a track record, they have history. So you want to really dig into those kinds of things, 100%. So as a high net worth investor, I would definitely spend maybe more time than you think you might need to on checking out the sponsor. And I'll even give you a tip that might save you $50,000. I invested in a deal with a guy. He was one of these great salesman guy. I thought his story sounded a little aggressive. Like I thought the return sounded a little high, but not like in the stratosphere. I thought they were achievable. But I invest $50,000 in his deal. Come to find out later, the guy's a swindler. If I had just here's the tip. If I had just Googled his name, now this was in what 20 is in like 2000, maybe 7, 8, 9, somewhere in there. So Google wasn't as popular as it is now. But had I just Googled the guy's name, I would have seen that he had a sketchy history and that he had ripped investors off before. So that would have saved me 50 grand. So hopefully it saves somebody out there 50 grand. Google your sponsor's name and their company. That's as simple as that. It might save you some money.
Good point there, Tom. And that's unfortunate that it happened to you, but I'm glad you could laugh about it. And hopefully, sure, our listeners can learn from that experience you had. With that noted, that kind of takes me to another area, right? So there's a difference between how you can invest in various commercial real estate deals. So sometimes I talk to investors and they're like, "Oh, I'm investing in real estate. I'm investing in a REIT." Right. So when we think about maybe REITs or funds versus investing directly into a property, explain kind of the pros and cons and the differences there.
Sure. So I guess there's a few different layers there, John. So I think a lot of investors, the reason they get into real estate is because they want to get out of the ups and downs of the stock market. And so going into a publicly traded real estate investment trust or REIT, it kind of defeats the whole purpose to me in my mind. And I know maybe it doesn't track perfectly with the market, but it's going to get impacted by movements and tsunamis in Japan, or all these outside forces that do impact the public markets. So I would say there are private REITs out there, but I'm not even sure how you invest in those. But anyway, the other way to go would be to find a fund, and again, if you go into LinkedIn or Facebook or any of these groups, you can find a lot of people that are raising money for funds, and I think funds can be a good vehicle. But I guess my issue, again, as an investor, with my investor hat on, is I'm not a big fan of just handing over investment dollars to a blind pool when they might have a strategy, but they might not have the properties identified yet. And so, but yet they're paying me a return. So where's that return coming from? It feels like they're sort of cannibalizing their own portfolio or their own cash position to pay me if they haven't made an investment that's generating income. So that's where I struggle a little bit with the fund model. And I think it doesn't align the interests of investors and the fund manager, the sponsor, as well as direct. We're at Belrose Storage Group. We're direct investors. We raise capital for our deals, deal by deal. So the investor, we can go to our investors and say, "Hey, here's the specific deal. Here's where it is. These are the characteristics of the property. Here's our strategy with this asset, and this is how we're going to grow the value and generate the cash flow. And this is going to be our exit strategy." So, to me, as an investor, and because I play both sides, I like that story better, and I think it aligns the interests of the sponsor and the investor a lot better, just going deal by deal. Because we have investors who they've been with us for years, but sometimes they'll say, "Well, I don't really like that. I don't like that particular deal for whatever reason." And so they don't have to invest in that one. They can wait for the next deal to come out, and then they'll be more comfortable with that deal for whatever their sensibilities are, whatever their investing goals. It lines up better. In a fund, it's different, right? So they might acquire a bunch of properties in that portfolio, but how much as an investor do you really know about each one, and are they meeting your investment criteria? Sometimes it's hard to tell.
Yeah, good feedback right there. So one, you said when it comes to looking at a REIT versus investing directly, the REITs, they're basically publicly traded
Mm-hmm.
stock. So now you're sitting here, and if your goal is to pull some money out of the stock market so you're not as reliant on it, kind of investing in REITs really defeats the purpose in one way, right? So that was one thing. You said under the fund model, while there's a lot of advantages there, the challenge with the fund model is you're not necessarily looking at it on a deal by deal basis. So maybe some of those properties don't fit your criteria, or they're in locations maybe you're not as thrilled about. But that's the one downside of the fund versus investing directly in the deal, where you get a chance to take a look at it,
Mm-hmm.
understand what's going on, the story, the business
Right.
plan, and then make a
Mm-hmm.
decision from there. So really some great advantages of investing directly versus a fund or a REIT model. On the flip side of that, when you are, waiting on a deal, one, there's the time frame, right, to actually wait to get that deal to come into market. But then also, if you're in a fund or a REIT, you get the diversification of other assets where your investment is spread across. So that's the ups and the
Mm-hmm.
downs of going that model. But,
Yep.
to each his own. I think it's really important to understand, that sponsor as well, and just understanding what's their business plan, their strategy, the track record, and then let that kind of drive how you move forward from there. What are you seeing in
Right.
self storage specifically right now? How are you looking at the market? What kind of deals are you looking at? What's your criteria?
Sure. Yeah, we're super excited about self storage, and if you look back over history, John, we actually have a graph in our investor deck that goes back like 40 years, and it shows the U.S. economy kind of bouncing up and down over that time period. Contractions, expansions, crashes and bubbles and all that stuff. But meanwhile, on the top of that graph, it just shows this nice, little meandering, lazy river line of the occupancy in self storage over the past 40 years. And it's just kind of calmly and coolly bounced between like 80 and 90% over that time period. So there's been tons of good times and bad times over that stretch, and storage just continues to perform well. And I guess there's a couple reasons. One is when times are good, people are buying stuff that they don't need, and they don't want to get rid of it. And, so they get at the storage unit. It might be a couple $100 a month, but in good times, that couple $100 a month, almost becomes like a Planet Fitness kind of model. Or, we try to put them on auto pay. So, it just comes off their credit card every month. And if times are good, they're kind of shrugging a shoulder. I'll get to it, next month, or, when the weather breaks or whatever. And so next thing you know, they're thinking they're going to rent this unit for 6 months, and then come back 3 years later, and they're still in it. So we hear that a lot. But in bad times, John, I mean, that's when people really need storage, right? Because they're having to downsize their house. Maybe a loved one's passed away, and they need to, they want to keep the contents of that house that's now empty. Has no one living there, and then there's divorce and displacement, and then of course during the pandemic, all of a sudden people were forced to work from home. Well, you got to take that bedroom furniture from that spare bedroom and get that out of there, so you can put your desk and your chair in there, so you can actually take care of business in your home office. So that was a big push as well. And another thing is just the demographic trends. I think people, younger folks now, millennials, are looking at smaller houses. They're not looking at the McMansions that their parents lived in, and they, as their overall housing strategy, John, they look at having a smaller house or apartment, and then down the street they want to have their toys in their storage unit. So they still want their bikes and their kayaks and the holiday decorations and whatnot, but they don't have the room in their smaller home or apartment. So they keep their stuff down the road in storage. So again, good times, bad times, storage is pretty darn steady.
Yeah, you didn't use the buzzwords we always hear, but recession resistant is what we always talk about, right? But good
Yeah.
times, bad times, there's a user, buyer, client, for that property
Hmm.
during those various timeframes. And it makes a lot of sense because, like you
Yeah.
said, there are people who want to downsize, there are people who want to, just store stuff away for a little bit, different transitional life situations that take place.
Hmm.
Self storage definitely is a solution. Now, many of our listeners are very familiar with multifamily. You guys hear us talk about the importance of population and job growth and all those different metrics. What do you look at
Hmm.
from a self storage standpoint? Are there specific metrics that you're looking for when identifying a market, or is that just not as relevant?
No, it's totally relevant, John. And in fact, we follow a lot of those same criteria that the multifamily guys do. In fact, we love to see multifamily being built in the markets that we're looking at. Because again, going back to the smaller habitational real estate, those folks still want their stuff. So we like to see housing starts in our markets. We like to see multifamily. We like to see a certain percentage in that market of renters. But yeah, we're looking at those same things. We're looking at the population growth. We're looking at job growth. We're looking at unemployment being low. We want crime to be low. So all those things that I think run very much in parallel with the multifamily market for sure. Um, but we're also looking at path of progress, right? So where in that particular area, where is the growth moving toward? And we're looking at uh, just the overall kind of characteristics of that economy, right? So we don't want a one factory town, right? We're looking for a diversified economy. We want to see that there's a lot of healthcare jobs, a lot of education jobs, a lot of local government jobs, a lot of whatever other agricultural kinds of jobs. And so we were looking at those, and we're not in the big markets. At least Belrose Storage Group, we're not in the bigger markets. We're finding we're getting better execution on deals in the secondary and tertiary markets. And because that's when you're going into the bigger markets, that's when you're really bumping heads with those big guys. And so we avoid that competition. We don't want to get tangled up in an auction situation, going against a huge private equity fund or something like that. So we like to stay in those secondary, tertiary markets that are still growing, right? I mean, folks are, especially post pandemic, folks are leaving the more urban areas and heading out to the suburbs, exurbs, and rural areas.
What are some of the markets you play in today?
Right now, John, we're in Maryland, Virginia, North Carolina, Georgia, Florida, soon to be New York State and Kentucky, and certainly down like in the southeast, like the Georgia, Florida, the Carolinas. I mean, those populations are certainly increasing, and there's a lot of it's dynamic kind of markets down there. The deal we're doing in upstate New York, you wouldn't think of that being a great market, but there's very little competition in that market, and the storage facilities that are there are full, and they charge a lot. And it's a very steady, population. Like it's one of those places where just people stay there for generations and generations. And there's money up there, right? It's a pretty wealthy, low crime kind of area. So we dug hard into that market because when the lead first came up, we generate our own leads internally so we can go direct to those sellers. When the lead first came up, we definitely, kind of, I don't know about upstate New York, but when we dug into it and we used our databases, we have multiple databases that we use to get that demographic information. It was a little different story than our, Florida and Georgia stories, but it's a pretty darn solid story. So we're excited about that deal for sure.
Awesome, great to hear. And with these different markets, right? You mentioned Virginia, Maryland, the
Mm-hmm.
Carolinas, upstate New York now, Kentucky, kind of, a wide ranging geographic footprint there. How
Mm-hmm.
are you managing these properties? Are you all vertically integrated? Do you work with third party managers? How do you approach that?
Yeah, great question. Yeah, because operations is so critical, like we talked about earlier. So we have a corporate manager who is in charge of she basically manages the managers. And she has 16 years experience in self-storage. I think 16 years ago, I didn't even know self-storage existed, but she's been in it a long time. And so she's been there, done that. And so what she does, she has very specific criteria for hiring managers. And one of the things, John, that makes us super competitive and able to generate great returns for our investors is we do a hybrid management model. And what I mean by that is we do not have a manager on site all the time because the facilities that we own are pretty full. And so there's not a lot for the manager to do if they're just sitting there. So it's really more of an on-demand management kind of style. And especially too, during the pandemic and now post-pandemic, folks are really used to now, just using their smartphones to take care of business, right? So anyone who's in our, near our Lynchburg, Virginia facility, for example, if they, punch into Google, storage near me, they'll find Lakeside West Self Storage. They can go right to our website, and from their smartphone, they can rent a unit. And so you don't really need that body on site, right? And of course, there's going to be issues from time to time where someone does need to be there. That's why we do have an on-demand kind of structure. If there's problems with the gate or problems with a particular unit or that kind of thing, we can certainly handle those issues as they come up. But a lot of times it's just handled by phone, email, texting, those kinds of things. So that again, that really helps us keep costs down because of course headcount is a huge expense for any business out there. So we're able to really kind of minimize that.
And then from an approval standpoint, you mentioned just it's as easy as picking up your smartphone, going into Google, and you can rent a unit directly from the phone. So approvals, what does that process look like? Because I know that you mentioned anywhere between 80 to 90% your field, but obviously you have, multifamily, we'd have evictions, but in your case, I think you just take the lockers or the units back. But talk to us a little bit about what that process looks like.
Yeah, I'm glad you highlighted that, John, because that is one of the big differences between self-storage and like a multifamily situation is we live in lien law world as opposed to landlord tenant world. And so the advantages are huge in that world for the property owners. And so we do have eviction processes, but it's nothing like the landlord tenant days. Like when I owned my single family rental portfolio. I mean, geez, what a nightmare having to go to court, and it was expensive. You had an attorney involved, and then I'm here outside Philadelphia, which is a very landlord unfriendly kind of environment. So I had just some crazy stuff. We'll have to save that for another episode, John. But I had some crazy stories about landlord tenant court in Philly. But so in lien world, though, it's that 61st day that they are not paying. There's a notice that goes up, and then their stuff is sold about a week later. Whoever wins the auction, everything's online now, right? So there's auction sites out there where our managers will post pictures of the unit, and there are folks out there that are looking to buy this stuff. I don't know if they sell it at flea markets or what, but they buy it. They look at the pictures, they make an offer, and once they buy it, they have 3 days to get to the facility and clean out that unit. So they're basically doing a turnover for us. And so we might have to go in there and just sweep it up a little bit. But that unit can be then ready to rent again that day. So our turnaround time on units is way faster than multifamily, way faster. So that's a big advantage for sure.
Yeah, so you said on that 61st day of non-payment, so basically missed 2 months, 2 payments in a row.
Yep.
Then it goes into they have a week basically where that notice goes out. You take ownership back, do an auction, clear out that unit, and it can be re-rented right after that. So definitely a big difference in what we see in multifamily. And something to keep in mind as well. Listen, if anyone wants to learn more about, investing with your group or going into self-storage, we've got your website right here, belrosestoragegroup.com, and you can check out that SAFE, SAFE investing ebook. And Tom will be happy to talk to you more. Right now, we're going to go on to our round of insights. Ready?
Let's do it.
All right. Give me a failure or an apparent failure that set you up for later success.
Well, I think I touched on it early in the show where, getting fired from a job is a pretty big failure. But I think that's what needed to happen to me to really, force me to go out and start my entrepreneurial career. And I'm 16 years in now, and I wouldn't change anything for the world.
Give me a digital or mobile resource you recommend for your business.
Wow, we are huge fans of Basecamp. Basecamp is basically a project management tool, but it also helps to manage teams. So we're basically running our whole business on Basecamp. In fact, we're using it to replace email and just share things across the company or with a specific group. So it's been great for us. And when we're doing an acquisition, the whole acquisition checklist is in there, and everybody's assigned their particular duties with a due date. So it's really easy to keep people accountable and just track progress. Super great tool.
Give me the book you've recommended or gifted the most in the last year.
This one might be a little different than your normal answers, but it's called The Last Place on Earth. And it has nothing to do with business, but it actually has everything to do with business because it has incredible leadership lessons in it. And the short book report is that it's the race to the South Pole, and it's happening at the turn of the century, going into the 1900s. It was the last place on Earth that had yet to be explored and discovered. So there was a race between the wealthy, well-equipped, snooty British team. Sorry to my British friends out there. Versus the hippie Norwegian dude that went and hung out with the Eskimos in Greenland and just pulled in his team and from all different places and was very poorly funded. In fact, he had to go out and raise money for his deal. So I know what that's like. But it's a great book. It's an adventure book. But there's so many great leadership lessons in there. Just about coming up with a plan, sticking to your plan, executing, getting into the details. How does this work? So I think it's a lot of fun to read, and there's some great lessons in there.
What's a daily habit that helps you stay focused on your goals?
I'm one of those, bed maker guys. I make my bed every morning, and I think that just is sort of it sets me up well to then just start my day on a positive, note. And then from there, kind of going back to Basecamp, I mean, we have our corporate goals in there. And so everything that we do is we're down to the minute steps that we need to take care of, but those are all supporting the larger goal that we all have agreed to as a leadership team. We do offsite events 4 times a year where we just kind of get away from the day-to-day craziness of the business so that we can go out and work on the business. So that's a huge help for sure.
Love it. All right. Give me your number one insight for self-storage investing.
Do it. Self-storage, it's been around for a while, and it's going to continue to stay around. I know we've got some potential economic headwinds coming up, but as we've talked about, John, storage performs great in up times and in down times. So I think it's a great time to be in storage. I think it's a growing industry. It's an industry that is just now kind of coming into the forefront. A few years back, only 1 in 15 Americans used a self-storage unit. Now it's 1 in 10, and I would expect that trend to continue going forward.
That's a great stat there. You are in Philly or outside of the Philly market, so give me your favorite place to grab a bite to eat.
Ooh, well, to give you a little insight into our company, we do like to have a little fun, and so we're called Belrose Storage Group, because there's a great restaurant here in town called 333 Belrose. And that's where we go to relax a little bit and get our juices flowing a little bit, maybe after a cocktail or two, and get some have a lot of fun and talk some good business in a really great environment. Great food.
Excellent. Make sure you put that on the list there, and you can check that out next time you're in the area. Listen, Tom,
Absolutely.
you gave us a lot of great insights. You talked about kind of your background, moving from corporate America in the finance space into, real estate, specifically here in self-storage, some of the things that your team works on right now. And again, if anybody wants to check out that ebook, the Safe Investing ebook, they can go to belrosestoragegroup.com. You also talked about just, what it means to invest directly in a deal versus a fund, as well as, a REIT, and just some of the advantages, the pros and cons there. And I just really appreciate you sharing more of your story. So for all of our listeners, be sure to check you out there. Tom, I just want to thank you again for coming on the show. We hope you have a great day.
Thank you, John. Great interview. Appreciate it.